Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of July the 8th, 2024. Now, to get started this week, we'll begin with that very important US dollar index. Fed is about to come under significantly more pressure to cut rates. If the dollar goes down here, guys, basically most other markets go up. So the unemployment data coming out of the US, very poor report again. In my respectful opinion, they've all been mediocre to poor reports, but the unemployment rate continues to move higher. The U6 is holding up at 7.4. So this is going to put pressure on the Fed to cut. Now, that's probably not going to be in July, but September, November, December are very high probability now. So that should keep the dollar under pressure. Now, in this particular setup, we can see that we're starting a new month, but we're also starting a new quarter. And you can see that the Vantage Point T-Cross Long is below the quarterly opening price, and now the market is cutting below that too. The key point here is that Vantage Point was showing problems with the dollar on Wednesday before this move actually happened. The payroll numbers come out. That's a fundamental event. Guys, we're not just trading technicals or intermarket technicals. We're also heavily trading fundamentals right now. And it's all based around global interest rates. So this is saying that the dollar is in a bit of trouble here. Now, again, the dollar usually will rally again in the month of September, and that's about it. So our T-cross long for next week, 105.40. This is a critical level that we need to hold under. The indicators are continuing to point down, but we do have a heavy docket next week with CPI. We've got a Fed speak. It'll be a very interesting testimony from the Fed this coming week as to how he's going to explain why he's not cutting. So once again, I believe the market is already pricing in cuts now. Probably nothing is going to happen in July, but like I said, September, November, December, that's the focus. So the core indicators in Vantage Point remain weak. Now, when we look at gold prices, gold immediately responding to that. But as you can see, this move was already starting. We're using the Vantage Point T-Cross Long in combination with the current new monthly opening price, but more importantly, the new quarterly opening price. As I've talked about repeatedly in these presentations, that my view is that gold is going to benefit regardless. If the US goes into a recession, that would also benefit gold. But as we come along the T-Cross Long, you can see we've started to extend higher on gold on July the 3rd, and now we're advancing higher. Now, we do have some stiff verified resistance highs, but I believe by year end, we will easily take these out as the Fed will be backed into a corner where he will have to explain why he's not cutting here. So as long as that's in play, gold longs remain in play. So for next week, our T-cross long, 23.37. If we click on our F8 for more aggressive traders, we can use our long predicted. That's the long-term crossover without the black line, just the predicted moving average. That level for Monday's trading will come in at 23.51. So all of our support is sitting there. The indicators look quite bullish. I wouldn't be overly concerned with the predicted RSI at 86.3 because again, I believe this move is just starting and we should be looking at targeting, I would argue above 2400 potentially in July, potentially the 2440 area. Now, the S&P 500, the NASDAQ, most of your global indexes are benefiting from this. But once again, what I'm looking for here is our Vantage Point T-Cross Long to cross over the current new quarterly opening price and the new monthly opening price. That critical level is 54.58, so that would be our retracement point for next week. If we, again, click on our F8, you can see that this leading predicted moving average has remained above the new quarterly opening price right from the very start, and it's extending higher. The indicators here look good, but again, guys, nothing goes up and nothing goes straight up or straight down. Our quarterly opening here is 54.71, so it's very easy to identify where our critical support is. As long as there's pressure on the Fed, there's going to be upward pressure on gold, on the major global indices, and a number of the different Forex pairs. But the main thing we want to look at is, do we have momentum here? The RSI is a little bit high at 90.2, but again, the markets can go into overbought or oversold periods for a very lengthy period of time. So again, as long as we understand where that retracement area is, then we can trade it, and that also assists with where proper stop should be placed. Now, when we look at Bitcoin, Bitcoin for this particular month is under pressure, which is normal in the month of July. 52,000, 52,500 area. That's your key area, guys. But this bar here, in my respectful opinion, is the one to keep an eye on. We've had a big push down, and as you can see, in most cases, whenever you have a long bar like that, it usually leads to some type of retracement. So right now, our T-cross long, 61,316. And again, the next bigger move in Bitcoin is likely going to be in that September, October area. We're likely to just go sideways. But remember, we are still bullish on Bitcoin while above 42,501. And the monthly target area currently is at approximately around the 52,000 mark, where I would look for some type of bullish move. So again, watching the indicators very closely. As you can see, something has triggered the neural index strength and the neural index itself. They're both pointing to the upside. And again, on dollar weakness, Bitcoin can feed off of that. So the minimum retracement next week, 61,316. If we click on our F8 in our software, our first target point here would be the long predicted at 58,897. Once we clear that, we target our T-cross long, and then hopefully we can get past that and start moving back to the upside. Now, when we look at some of our additional markets here, once again, when we look at the VIX plays a pretty strong part in this equity move here. The VIX remains still negative. Now we're below our yearly opening price at $15 per share. Our T-cross long is sitting at 13.96, and it's about to cross over the quarterly opening at $14 per share. If that happens, that's a bearish event, guys, and that would point us towards buying your major indices, your NASDAQs, your S&P 500, maybe your DAX 30, some of these markets. But we've also got some support building down here. We've got a new verified low, 1310. So we'll keep an eye on that particular area. Now, we do have a corrective signal in the VIX. That's all this is, guys. While we're below our T-cross long, the MA diff cross is telling us we're in a corrective phase back up to this level. Now, again, the T-cross long and the new quarterly opening at $14 per share are intersecting with each other. That is a major level. And then we have the yearly opening price for additional resistance on the VIX. So unless the Fed comes out and digs his feet in and says he's not cutting no matter what, then the VIX is likely moving lower once we get past this corrective move to the upside. Now, oil traders for this coming week, once again, we're coming into some fairly significant verified zones here. We've got our April the 4th, that's about 87.12. Then we come down to April the 19th, we're sitting at about 85. And then again in April, once again, with a high at about 84.23. So we've got some pretty stiff resistance up here, which I believe will likely hold. So right now, we can see that our T-cross long is moving higher towards our current quarterly opening price. A lot of activity or retracement points are likely to come around this 81.45 area. So we'll keep an eye on that right now. But again, I do think we will have some sellers in this area, but we're also in a pretty strong seasonal area here with summer driving season starting. So demand for oil usually and our gasoline contracts usually picks up around this time. So we'll watch that area very closely, but once again, still an underlying bullish tone once we get a corrective move lower. So that T-cross long 81.14. When we click on our F8, you can see that we can bring this right in for our day trading there, and our long predicted for Monday 82.85. That's the area I would watch, and then we do a comparative to the predicted low for Monday 82.46. But always remember, guys, this is not a daily outlook. This is a weekly outlook. So we're using medium to longer term indicators to gauge the strength or weakness for the entire week, not just for 1 or 2 days. And that's why I keep the main long predicted on here and the T-cross long. I don't want short-term indicators confusing the weekly move. Now, when we look at our European equity markets, once again, our DAX 30, that's coming in, showing some strength with the S&P 500. You can see it's moved on the exact same day. It's coming off the same level, our quarterly opening price, but now our T-cross long has slipped above the new quarterly opening. So all of our area on your DAX is going to be down at these particular lows around 18,236. So as long as you're holding above that area, everything looks good. And again, if we use a more medium-term predicted moving average, it's confirming the same, that area at 18,335. So that covers your main global markets here as to what we're expecting for next week. But again, a heavy docket with the Fed testimony, CPI. I think we have our Michigan survey is coming out on Friday. So it's a busy week again. So when we come into some of our main Forex pairs, the euro responding very positively to the dollar selling off. But I would argue, again, that the political winds of change are somewhat happening in Europe right now, and it appears to be a positive move. I believe it's the French elections are coming up next, but either way, the euro is about 99.8% inversely correlated to the dollar index. So the dollar index goes down, the euro goes up either way. So right now, again, we've got very good, we're starting off the quarter very bullish on the euro and very weak on the US dollar. This is likely going to continue, but always remember, guys, the euro is still in a downtrend on the year. 110.38, the euro has never been above that level in 2024. So technically, it's still negative on the year, and this is a corrective move until we can get above 110.38. But it does look promising, especially if we get a Fed rate cut. Now, the U.S. Swiss franc, once again, even with the Swiss National Bank cutting for a second time, we can still assess that that dollar weakness is persistent in this pair. So now we're just crossing over our quarterly opening at 89.72, and we've got our T cross long at 89.77. Those are your sell points for the week, guys. As long as we're holding below that, any retracement, or I could even make a more aggressive, potentially a more aggressive move right off the open tonight on Sunday night, because again, this video is being done on Sunday morning at 10:37, and it's an outlook, not a recap of something that's already taken place last week. So this is a potential for what I would coin as an open push, meaning it just goes straight down right off the open, because now anybody that's caught long on this particular pair, anticipating stronger inflation data, they're going to be looking to get out of this trade, potentially the long trade, as quick as possible, and that could be Sunday night. So watch this pair for a potential spike to the downside right out of the gate. Now, the British pound US dollar has once again cleared our yearly opening price, but not in an overly convincing manner. So our yearly opening price here, very important retracement point. That yearly opening price coming in at 127.32. That's the key level to watch for next week. Our T-cross long, it's coming in at 127.06. The indicators remain bullish, a little toppy on the predicted RSI, but again, we've got room to extend. My only bit of a concern is this high at 128.60, that verified resistance high. I think we're going to struggle a little bit at that area, probably on Tuesday. And then on Wednesday and Thursday, we start moving higher again. So again, when we look at our F8 in our software, the long predicted is now directly intersecting with the current yearly opening price. We're firmly above the quarterly opening, but that level around 127.32 with the predicted moving average sitting right on it, that's a make or break area, guys. This trade either works here or it doesn't. So the predicted low from VP on Monday is a little lower at 127.84. I believe we potentially can get down there. Yes, absolutely. But we've also got a bit of a gap between the predicted low at 127.84 and our first major support level at 127.33. So I would respectfully submit that you target longs between those particular levels. And again, I have to be cautious about what I say for stops, but I would not have a stop above 126.39, because again, that quarterly opening at the beginning of the quarter is very, very important. Now, with the dollar yen going into next week, the question will be, can the dollar even lose ground against the carry trade? That will be, or will the market look at this and say, okay, the carry trade is long dollar, short the Japanese yen. This has been in play for a couple of years, guys. And when a carry trade comes unwound, it can come unwound very, very quick. So if they believe that Bank of Japan could hike, and there's going to be multiple cuts from the Fed, then this pair would likely sell off very, very quickly. But the carry trade is a very powerful one right now, and it will take a lot to move it for them to exit those dollar longs on the interest rate differential. So for now, our T-cross long 159.83. But again, the quarterly opening is the best advice I can give you. 160.72, that's the area. If we're holding below 160.72, the dollar is likely going to come under pressure, even against the yen. So right now, the indicators in VP are suggesting that is what's going to happen. Our neural index strength is down. Our predicted differences are pointing down. And we haven't had a lot of movement out of the predicted RSI in some time here, but now we have it. So with that predicted RSI, if it can break down below the 40 level, and currently it's at 49.5, it's crossed over the 50 level, but if it crosses the 40 level, then you could see a fairly significant exodus out of this carry trade. So keep an eye on that. But my advice too is be very, very cautious with this pair. It's going to be it wouldn't surprise me if the Bank of Japan did something tonight, because they're going to leverage that weaker payroll number and the weaker inflation data as of late to say, look, we're looking at intervening in the markets, we're going to hike again. That would send this pair into the 150 area, 152 area very, very quickly. So, but expect heightened volatility with the pair. Now, the US Canadian pair, very dismal labor report out of Canada on Friday, far worse than the US, in my view. But the Bank of Canada has been clear. They're cutting. Multiple cuts are coming. So I use that as an intermarket correlation, that because the Bank of Canada was the first one to get out in front of this with COVID in hiking, and the Fed wouldn't. So now the Bank of Canada is saying they've already cut, and they've said a whole bunch more cuts are coming. So I'm taking that is that the Fed is going to cut, and that could actually benefit the Canadian dollar. But in most cases, if the US dollar is weak, then the Canadian dollar is usually weak with it, because they're our biggest trading partner. But for now, again, when we look at the structural bias of this particular market, our T-cross long is sitting at 136.77. That is the core area that we want to keep an eye out, because the quarterly opening is sitting there also. We're still above the yearly at 132.50, but that's our retracement point, guys. So I believe that the Canadian dollar, even though the Canadian economy is not doing well, there's a high correlation between the Canadian dollar, the gold, oil, but mainly those equity markets. So if the gold and oil and stocks continue to move in this direction, then again, we look for buying Canadian dollars, even if the US dollar is not doing well. So the indicators saying a little bit of a retracement, but that's the area I would keep your eye on this week, is rate anything just under 137. Now, when we look at the Aussie and the Kiwi, I believe that we could be coming to a turning point with the Aussie currency. If you look at the global foreign exchange reserves, they continue to move lower or out of the US dollar and into other currencies like the Korean won, the Canadian dollar, the Aussie dollar. So we're moving fairly aggressively towards the current yearly opening price on the Aussie, and that's 68.12. That is the critical level we want to keep our eye on. If it's going to fail, that's where it's going to be. However, if we get above it, we should have a couple of good quarters of buying on the Aussie. And again, I still, regardless of what the Fed does, I anticipate the US dollar to be strong in the month of September, because that's the fiscal fourth quarter, which ends October 1, and then the dollar sells off. So keep an eye on this, but right now the indicators are all pointing up on the Aussie. That's your only real obstacle up here, is 68.12. And very much like the euro, when we look at this, the Aussie has not done well in 2024 at all. But again, now we're at a potential turning point here with interest rates. The same thing would apply to the New Zealand dollar. As you can see, I respectfully submit that maybe there's a little bit better value in the Kiwi here because the Aussie US, New Zealand US trade, basically the same, but this one has a little bit better value, in my opinion, more room to extend to that yearly opening. The indicators are sitting positioned slightly better. As you can see this past week, they've been buying the Aussie a little bit more than the Kiwi. But again, I like value too, the Warren Buffett approach of, we always want value in what we're trading, right? And when we do look at things like value, I was asked to revisit this First Solar stock again because I was asked, well, how did I know it was going to sell off from this area? Now, I talked about this particular stock about a month ago, and I advised that be very cautious of buying this up here because, again, in most cases, it's a bull trap. This stock was up here back in 2008 at almost the same level, and then it sold off for basically 15 years. But now we've got maybe a little bit of a different picture on this particular stock, and so we've dropped about $100 a share. We've come all the way down to a low of 214 from when I had talked about it up here at just under the $300 share mark. But now it looks like we may have a bit of a buy signal forming. So this is again, when I talk about retail traders tend to buy high and sell low. Uh, that's just a word of advice to say, look, let's get some value out of this thing first, because if it's going to sell off, this is where it's going to be. So they push it up a little bit to back where it was, I believe, in around 2008, and then it was just they take profit and they come out of it. But now you've got something else forming here. So that quarterly opening, that's all we're looking for. That's the whole point of that statement, is to make sure we're looking for value, because a lot of times if we buy high and sell low, we get caught in these bull and bear traps like what happened here. Because again, that was a very significant drop. Even if you look at it from the area when I discussed it, that is a big drop, and that's all that was being mentioned there. It's almost a 30% drop in this stock. So now I believe we've had our corrective move, and maybe this stock can get back on track and ultimately break those highs. But again, I don't think there's any certain group of people that only buy high and only sell low. But that is at times what retail traders tend to do, because they buy the rumor, and usually the broker's on the other side of that trade waiting to trap you. So a very busy week next week, but with that heavy docket of economic data will definitely come opportunity. So with that said, this is the VantagePoint AI Market Outlook for the week of July the 8th, 2020.